Welcome to Talk Tickers. You're here for your shortcut to understanding the important earnings calls.
And today we're digging into Clean Harbors. Their first quarter 2025 results just came out.
Right, let's get straight to what matters. How did they kick off the year?
Pretty strong, actually. They finished Q1 ahead of expectations, which is always a good sign.
Okay. And headline numbers. Revenue.
Overall company revenue, it saw a 4% increase year over year. Solid.
Solid, yeah. And how did the main segments perform? Let's start with environmental services, ES.
ES showed some encouraging growth. They had a really strong March.
So it picked up later in the quarter.
Exactly. It helped offset some, weather challenges they had back in January.
Makes sense. What about the other big piece, Safety-Kleen Sustainability Solutions, SKSS?
SKSS actually outperformed what people were expecting.
Oh, interesting. What was behind that?
It seems to be driven by better pricing, specifically in their used oil collection business. They're getting more for taking that oil now.
We'll definitely need to unpack that later. So just drilling down a bit more on ES profitability, adjusted EBITDA.
Yeah, for ES, adjusted EBITDA was up 4%. That's on a 3% revenue increase.
So margins improved slightly there.
Just a touch, yeah. It points towards maybe some efficiency gains. And like we said, revenue growth was helped by acquiring HEPPO last year, but also pricing gains and higher usage of their incinerators.
Right, the HEPPO deal. How much did that move the needle, particularly in field services?
Quite a bit. Field services revenue jumped, get this, 32%.
Wow.
Yeah. A lot of that was HEPPO, but they stressed there was organic growth in there too. They handled over 5,000 emergency response events in Q1 alone.
Busy quarter for ER then, and technical services within ES.
Also up, about 5% revenue growth there. That was fueled by, higher incineration volumes and also better pricing for that service.
How much better was the pricing?
They said incineration pricing was up over 5%, and that's on a mix-adjusted basis. And utilization was really humming along at 88%.
88%, that's quite high. Does that include the new Kimble facility?
It does. And speaking of Kimble, that new incinerator processed about 5,000 tons in Q1.
That's first quarter.
Yeah, first quarter of operation. Wow. And they're projecting it'll do over 28,000 tons for the whole year. They saw momentum really building there in March and into April, too.
So that capacity is ramping up nicely. What about the rest of ES? Any weak spots?
Well, their Safety-Kleen environmental services part continued its sort of steady, profitable growth, revenue up 5%.
Okay.
But industrial services revenue did face some headwinds. It was actually down 10% compared to last year.
10% down. Why was that?
Mostly seems to be refinery customers delaying spending and maintenance work.
Any idea why the refineries are holding back?
Clean Harbors mentioned potential influences like uncertainty around tariffs and trade, maybe making companies cautious. Also, local crack spreads play a role.
The refiner margins. Okay.
Right. If those margins are tight, maintenance budgets might get squeezed. But importantly, they said this hasn't really hit their overall waste volumes or ER services yet.
So the core disposal demand is still there.
Seems like it. They did put through a small price increase, kind of anticipating higher costs for their fleet, chemicals, things like that.
Proactive move.
Yeah, and they said they're ready to, adjust pricing further or cut costs if needed to protect margins, especially if tariffs cause more inflation.
Okay, good context. Let's swing back to SKSS then. You said it outperformed due to used oil pricing. Can you elaborate on that strategy? The charge for oil?
Absolutely. So SKSS revenue growth reflected higher volumes, partly from the Noble acquisition they made, but the big story was this shift to charging customers for collecting used oil, the CFO initiative.
And that offset weaker base oil prices.
It more than offset it, yeah. Base oil demand and pricing were weak, but because they successfully started charging for the collection service itself, they came out ahead.
How much have they increased that collection charge?
Yeah, the average price per gallon they charge for collection has basically doubled since the end of last year.
Doubled, while still getting enough oil.
Apparently so. They collected 58 million gallons in Q1, which is actually up from 55 million gallons a year ago. So they're managing that balance.
That's quite a strategic shift. How did they manage the volume piece?
Well, one key move was idling their California B refinery.
Why idle a refinery?
It was their highest cost facility.
Good.
By taking it offline, they actually reduced the total amount of used oil they need to collect to feed their re-refining network, which helps support that charge for oil model. They don't have to chase every last gallon at any cost.
Smart. Any other developments in SKSS?
Yeah, they mentioned progress with BP Castrol on that partnership for more circular lubricants for big corporate fleets. Signed up 2 large fleets already.
Okay, that's interesting.
And their Group 3 program, that's aiming to produce like 2 to 3 million extra gallons of higher value base oil this year. That's also moving along.
So lots happening there. What about how they're using their cash, capital allocation?
They emphasize they're in a good spot, strong cash balance, low leverage, gives them flexibility.
For M&A or internal stuff?
Both, really. They said they're actively reviewing multiple M&A deals. They're focused on, finding synergies, cost savings, and chances to cross-sell services.
Makes sense. And internal investments.
Continuing work on the Kimble facility, obviously, also expanding in Baltimore, and they just bought land in April for a new hub in Phoenix.
Expanding the footprint.
Definitely.
Yeah.
Plus, they opened 10 new field service branches just in Q1, and they're adding more processing and recycling capabilities at existing sites, too.
Anything else on the investment front?
They're also looking into ways to further process the byproducts from their re-refining business, trying to get more value out of everything.
And share buybacks. Still active there?
Yep. Bought back nearly 260,000 shares in Q1 for about $55 million. And they still have over $430 million left on their current repurchase authorization.
Okay, so they're returning capital too. Looking ahead then, what's the guidance for the rest of 2025? Did they change anything?
Nope, they reiterated their full-year adjusted EBITDA guidance, still targeting $1.15 billion to $1.21 billion.
That's reassuring stability. What about the next quarter, Q2?
For Q2, they expect adjusted EBITDA to grow maybe 1 to 3% year over year. ES should grow 3 to 5%.
And SKSS.
They actually expect SKSS to be slightly down in Q2 compared to last year, but they think lower corporate expenses will offset that dip for the total company number.
Interesting quarterly dynamic.
Yeah.
And full year segment views.
Full year, they still see ES adjusted EBITDA up 5 to 8%. SKSS, they're projecting around $140 million for the year.
Okay.
Corporate segment negative EBITDA is expected to increase slightly, 3 to 7%. And adjusted free cash flow guidance for the year also remains unchanged. $430 to $490 million.
And that excludes the Phoenix project cost.
Correct. Excludes the $15 million for that new Phoenix hub.
So overall sentiment seems pretty positive.
Yeah, they're anticipating strong demand pretty much across the board: disposal, recycling, remediation, Safety-Kleen branches. Kimble ramp up, expected to continue.
And PFAS, that's always a topic.
Still seeing high interest in their total PFAS solution. That remains a potential growth area.
What about the industrial services weakness? Do they expect that to bounce back?
They're forecasting a, let's say, muted recovery there in the near term. But longer term, they still feel positive about the prospects. And for SKSS, they feel they're executing well on what they can control, especially those collection costs.
Right. So wrapping up the results part, it feels like, despite some headwinds like weather and that industrial dip, the core ES business is resilient. And the SKSS strategic shift is really paying off.
Yeah, that's a fair summary. Proactive management seems key, especially in SKSS navigating that volatile oil market.
And they're clearly still investing for growth, both organically and potentially through M&A. The guidance hold gives some confidence too.
Definitely. And that PFAS angle, the regulatory environment there, that's a significant potential tailwind for a company like Clean Harbors.
Okay, let's put on our other hats now for our This Is Not Financial Advice segment. Time for some outrageous but plausible trade ideas based on all this.
All right, let's brainstorm. Given that successful shift to charging for used oil in SKSS, they seem less tied to volatile base oil prices now, right?
Seems that way. They've built in some pricing power on the collection side.
Okay, so idea one. What about going long Clean Harbors based on that improved SKSS model and resilience, maybe paired with a short position in a company that's purely a base oil refiner?
So you're playing Clean Harbors' better pricing power against a company still fully exposed to base oil swings.
Exactly. You capitalize on Clean Harbors' reduced sensitivity and potentially profit if pure play refiners face continued pressure. It's a relative value kind of play.
Outrageous but plausible. I like it. Got another one.
Okay, thinking about the ES side. That incineration strength, 88% utilization, Kimble ramping up, plus the whole PFAS regulatory push.
Demand for specialized disposal seems pretty robust.
Right. So idea two, maybe a more aggressive bet. A leveraged long position in Clean Harbors, betting hard on sustained high demand and pricing for their disposal assets, especially with PFAS cleanup potentially accelerating.
Leveraged long. Okay. That's definitely leaning into the growth story. How would you hedge that, if at all? It feels risky.
It is riskier, hence the outrageous part. But maybe you could hedge it slightly with a small short position in a company or sector that's heavily reliant on industries likely facing increased environmental regulation and higher waste disposal costs, sort of betting on the cost side of the environmental equation hitting others.
Interesting. So long the solution provider, short those potentially facing higher costs from the problem.
Something like that. Again, purely speculative ideas here.
Absolutely. Just thought experiments.
Yeah.
Remember, everyone, this is definitely not financial advice. Please always do your own thorough research.
Crucial point. Okay, so that was our deep dive into the Clean Harbors Q1 2025 earnings call. We've hit the main results, dug into the segments, looked at capital and guidance.
Yeah, key takeaways for me were that ES strength, especially incineration, and the really smart maneuvering in SKSS with the charge for oil strategy.
Agreed. It shows resilience and adaptability.
So what stood out most to you listening? Any questions still lingering after hearing this? Remember, this is just the starting point for your own analysis.
Dig deeper, check the filings, understand the risks.
For Talk Tickers, this has been your curated summary. Join us next time as we tackle another key earnings report.
And one last time, not financial advice. Do your homework. Now go forth and analyze.